Hi, Sagafi, Liberty Home Mortgage. And what are we going to talk about today? We're going to talk about the ugly truth of how the Federal Reserve is going to combat inflation and what plan they have in the works for 2023 ahead, okay? Coming up and going through it, okay? There's three things you have to keep your eye on. This is something I've been talking about quite a bit, okay? They have to break three things whether you like it or you don't. And nobody likes it, but at the end of the day, what has to be done has to be done. Now, there's also a lot of stuff in the background. I really don't get political on my talks. I'm not about to start now. But at the end of the day, there's a lot of things in the background when you deal with supply chains, when you deal with government spending programs, because let me tell you two things that cause prices to go up. Cut the supply and increase your spending. For example, start handing money out to people and just giving them free everything, okay? When you start doing that, you're going to have inflation running out of control, and I don't care if you put rates to 50%. As long as you keep handing out money to people and cutting supply chains off and shutting everything down, you're never going to lower inflation. So take all of that, put it to the side while you're watching this video. Understand that I'm not completely blind and stupid to other things that are out there, but we'll stay away from some of that right now. There's three things they have to break, okay? Three things. Number one is the real estate market. Now let me tell you something. They've done it. Real estate has slowed. Mortgage rates have gone up from the start of this year. This year we were in the 2s to the end of the year we're sitting in the 7s, okay? That's a gigantic increase, okay? What has that done? That has caused people to shift the purchase price, the price ranges they could actually look at houses in. Instead of looking at a $500,000 home at a 2.5% interest rate, they've got to look at a home for $350,000 at a 7% interest rate. That has shifted everything down. Real estate has slowed. Home prices are still, the bottom line is you still have a supply shortage in there. So home prices are not really going to go anywhere in the grand scheme of things. But ultimately, real estate has slowed. That is the first thing that the Fed has to break. They've done that. Check that box off. Now, they're not done, okay? Anybody who's ever dieted in their life, I always tell people this is like going on a diet, people, okay? You don't go on a diet for 1 or 2 or 3 weeks. You go on a diet for years, and it ultimately becomes a lifestyle, okay? At the end of the day, what the Fed's done to mortgages and mortgage rates, it has unquestionably slowed real estate, but they have more work to do. The second thing that the Federal Reserve has to correct, and by the way, I've got some different charts and things like that here. And one of the charts I have is from the St. Louis Federal Reserve, and I show housing and housing sales and the average sales price of a house sold in the United States. From 2008 to 2010, home prices pulled back. They went up through 2007. They slowly started coming down. They dropped significantly in 2008 and 9. They leveled off and flattened from 2009 to 2012. Then from 2012, they started climbing. I've given these statistics at other videos I've done where had you bought at the peak in 2007, had you held your home until 2013, your home by 2013, only 6 years, would have been worth more than it was in 2007. And in between that time, you'd have experienced some of the biggest drops in housing since the Great Depression. So even though there's all these doom and gloomers out there saying, oh my God, house prices are going to crash, hold it for a couple extra years. And not only do you return to where you were, but it goes even higher. That's why housing is so strong. The second thing that the Federal Reserve has to break is the stock market. Now, the Dow Jones is down somewhere in the neighborhood of, I want to say, 10 to 20%. The NASDAQ is down, I want to say, 30%. The S&P 500 is down around 20% down. Since the 1950s, you will see that during recessions, the stock market crashes, and then ultimately it recovers and it goes even higher. The fact of the matter is right now, even though there's been pullback in the stock market, there still has to be more pullback. Have they done that? It's very similar to real estate. They're in the middle of doing it. It's being done. There has to be more pullback. The third thing the Fed has to break is unemployment. Unemployment right now in November of 22 is at 3.7%. We were at a low of like 3.4%. Unemployment has got to go up. They have got to get unemployment up into the 5s and 6s, which somewhat is near doubling where it's at. Does that mean good people are going to lose jobs? It does, but what's the trade-off? The trade-off is we're not going to be paying $5 a gallon at the pump anymore for gas. It's going to pull prices down. People don't like it when you say people have to lose jobs. But the reality is, big part of inflation, if not the biggest part of inflation, is spending money. Naturally, why do they have to raise unemployment? They have to raise unemployment in order to slow spending. When they break unemployment, by the way, I told you, number one, they have to break real estate. They're doing that. Number two, they have to break the stock market. They're doing that. Number three, they have to break unemployment. They are not doing that. There's been a lot of quotes from different Federal Reserve presidents saying that unemployment through all of these changes is relatively unchanged, okay? So they have not done that at all. That is the final hammer that is coming at the end of the day, that they have to keep raising these rates. Now, how does raising rates or raising the Fed funds rate, because they don't raise 10 different rates, they raise one, they raise the Fed funds rate. How does that affect unemployment, or how does that put people out of jobs? Easy. It affects businesses. It affects the businesses they work for. Those businesses are going for business loans. They're taking out loans. They have payroll. They're not bringing in as much revenue to the company. The revenue's down. Revenue drops. Guess what you do? The first thing you do, and I know this because I'm a business owner, the first thing you do is you cut overtime. The second thing you do, you start laying people off. The third thing you do, you start cutting pay of the people who still remain. And then the fourth thing you do, you shut your business down, okay? So this is the progression of what has to happen. But ultimately, unemployment must go higher. And I don't mean just a little bit higher. I'm talking dramatically higher, okay? Unemployment must go up. I have a chart for unemployment from the U.S. Bureau of Labor Statistics, civilian unemployment rates. When you look at this chart, you see unemployment low. Now, I will tell you, when I look at this chart, I see back in October of 2002, unemployment was over 6%. If I go to 2004, it was still at 5%, in the fives. It dropped to a low by 2006, just over 4. So the truth is, we're in the threes. Even getting into the mid fours and the fives only brings us to where we were during the first 10 years of 2000. So that's something that people always get confused also, is they think, oh my God, if it goes higher. It's just going to where it probably should have always been. We've been in an artificially inflated environment for the last 2 years. Unemployment has been way lower than it should be. Home prices, mortgage rates have been lower than they should have been, okay? The stock market is higher than it should have been. You have this whole recipe. The way they break it is by raising the Fed funds rate. These are the three things you have to keep your eye on. Keep your eye on real estate, keep your eye on the stock market, keep your eye on unemployment. More than ever right now, keep your eye on unemployment, because that's going to start going up. That's about to start going up very soon. I have other videos on that you want to pay attention to and watch. Keep following these videos. Like, share, and comment on these. Share them on your social media pages and keep following along. This is what's coming. I look forward to seeing you again.